would you do? Let's figure out a way for you to do that thing.
Right.
That's the most important thing in my world. That's why I want to help people, and that's why I want to talk to you today about this, because real estate is one of the easiest ways to break through the mold and be able to set yourself up to where, like, if you have yourself set up where you're not paying your mortgage payment, for a lot of people that's $20,000, $30,000 a year that they're flipping into, what else can I do?
Yeah,
you know
so
you can live the same quality life for $30,000 less if you make smart real estate investments.
I agree. So what we have to talk about before that, though, is the financial situation of people overall, right? So we know that. Well, what I mean is, I think that real estate's a great investment as an income property, as something that creates something for you.
Okay.
And so people, because I'm still on the fence of owning versus renting. So
you're on the fence about it, or you're meaning you specifically are renting?
I'm renting, right?
Yeah,
renting.
yeah, yeah.
And so will I go out and spend $350,000 on a house? Probably not. Why? Because I think the value is in buying something, an income property. And so before people talk, where the value is in real estate, we've talked about the savings rate of this country, because you need money to buy real estate, right? Yep. So how do you get the money? Well, currently the savings rate in this country is like 6%. So people, save 6% of their income, which is, it's probably less than that, because that's offset by massive mortgages, car loans, and student loan debt, and credit card debt.
Got it.
So we have to talk about debt. So none of people are saving, because you need some cash to buy real estate. Doesn't matter what you do and what piece of property. Whether you're a first-time home buyer, you need that 3.5%. Well, that 3.5% can be, $5,000 to $20,000.
There's some programs where you can get in for zero down.
Sure.
For the most part, though, you need 3.5%, probably plus an extra few thousand just to get through the process.
Right.
So you're looking at 3.5% of 100,000 is you're looking at 5,000 to get into a $100,000 piece of property, and in Alaska you're probably looking at 7 to 10,000.
And then we don't talk about beyond saving for closing costs and down payment.
Right.
So when you're renting and your faucet breaks, what do? Yo, come fix this. It's broke.
Yep.
Right. When you buy a house and your hot water heater goes out, who's on the hook for that? Right. Right. So, but everybody's just done spend all their money on getting into this place. Right. Now all of a sudden you got a mortgage and something breaks and blah blah blah. But now you're responsible for everything, and people don't have the money in place for that.
Right.
So then where do we save money? Let's talk about savings, right? Well, there's always the normal place is the savings account, right? But what do banks give you? 0.25%
interest.
Right. Yeah. Yep. Right. So because we want our money working for us. If we're saving our money, we still want it to work for us.
Yep.
Right? And I think that's what people miss that point, maybe in some respects. And so we want money to work for us. And what does that mean? Well, if we put it in the savings account, it's not going to earn anything. And if whatever it does is taxable. Put our money in a money market account. Well, it stays liquid, but there again, how much our money market's paying? Well, you can maybe find one at 2%. So let's say it's at 2%.
Okay.
And let's say you have $100,000 that you're going to put in there. First of all, it's a lot of money. Not a lot of people have that, but I like using round numbers. Well, 2% interest on $100,000 is $2,000. How much of which is taxable? 100%. 100% of your interest that you just earned on this $100,000 is now taxable.
Okay.
So it's taxable income.
Okay.
Right. So how much money?
And at 2%, you're not even meeting average inflation rates.
You haven't beat inflation. Inflation's 3%.
Right. Average changes, but average.
Yeah. So
overall, you're still losing money while your money's in a money market account.
Exactly. And so what people don't understand with inflation is that the dollar you have today will not buy the same shit that it's going to buy tomorrow.
Right.
That's inflation. Right. My dollar today will buy this Snickers, and tomorrow the Snickers is going to be $1.09.
Right. At 3%, your dollar next year is 97 cents.
Yeah.
Then it's 92.5 cents.
And if you really go back to when we got off the gold standard, let's look at inflation really, and it's just plummeted, right? So we don't have the graphs and all the information, but you can definitely research that and find that out. It's easy information to find.
Yeah.
So money market.
All you're saying is saving. You need to be able to save to get into a house, which I agree with you. And I have this conversation with all the clients that I talk to of, first of all, let's talk about you getting into a house and getting approved for the loan, because that's the most important thing, and establishing a payment that you're willing to pay for. Then once you have that, the bank's going to give you percentage and numbers and stuff. They're not going to look at your situation. Then I'm going to sit down with you and say, it's you and your wife. you need 4 bedrooms or do you need 3 bedrooms, right? Because you're 26 years old. I need 2 bedrooms, one for me and one for my baby.
Right.
That's it. I don't need an extra office. I don't need a 4th gym. I don't need a 3-car garage.
Don't need the yarn room.
Right, because saving that money at the end of the day is going to be able to flip me into getting that 4 bedroom at a later date if I decide that's where I want to be. But then it's going to be in a better position where I have a nest egg. I don't know why I keep moving this pad all around, but it feels real good. I'm
Yeah, so
making that smart decision, saving for it and making a smart decision with your money.
Okay, so then how do we... All right, so we got a savings account, typically where people save it. Money market account, fantastic. CDs, again, we're working at the same interest rates, maybe a point higher than what money markets are, however your money's locked up.
Right.
I'm not a fan of CDs. I will never suggest one.
Okay.
I never really do. There's way more better place to put your money into.
One of them better places.
Mo better.
It's better.
You know, at this point, here's how much I don't like CDs. I would just say put more money into your 401k, and I hate 401ks.
Hate's a strong word.
It's pretty close to that. It's a pretty bad industry and product.
Okay. Overall. What are you getting here, Matt Witwer?
So
tell me about it.
With real estate, so what we're getting to is where's the place to save money? Well, that's where one of the oldest financial tools on the planet Earth comes into play, and that's whole life insurance.
Okay.
And so typically life insurance is I got kids, I got a mortgage, I got a wife, I got debt. If I would die, I want my family to be taken care of.
Got it.
Right. That's where term insurance comes into play. Right.
Yep.
You're 26, you have $500,000 in debt, and you make 75 grand a year. That's about what you can afford, right? Term insurance is super inexpensive.
Okay.
So anywhere from $20 a month to maybe 100, whatever, depending on your age and whatever.
Okay.
So not saying that's it, but that inexpensive overall speaking, right? People spend way more money on their damn cell phones than they do on any of this other stuff.
Okay.
Right. So let's say it's $50 a month for term insurance, right? $1 million, that's what you got. Okay.
Okay.
Well, 1% of term insurance pays out. So most of the time, 1% of term policies pays out.
Okay.
So they don't pay.
Okay.
Right. That's not. They're there in case something happens during when you got 3 kids under the age of 10 and you got mortgage and you don't want to leave your wife behind with all this stuff. Okay. So there's term insurance. Well, the other side of life insurance is whole life insurance. And when it comes from a company, and so when it comes from so most life insurance companies, the best ones are mutual. What that means is they're not stock companies.
Okay.
So stock companies like Facebook, Google, Amazon, all these companies, you buy a piece of stock and I own a piece of Facebook now, right?
Right.
However, what that means, those companies are for profit, which isn't a bad thing, right?
Okay.
But they're there to give money back to their shareholders.
Okay.
In the life insurance world and life insurance companies, why it's been around, and here's another question to ask yourself, how long has these companies that are in the stock market been around versus how long are these companies these life insurance companies been around? Life insurance companies have been around for 200 years, dude.
Yeah. I mean, there's companies that have been around for 200 years too.
There are, but there are far more
Life insurance.
life insurance companies who've been around for 120, 130, 170. You know what I mean? Long time versus these companies, and they're sustainable, and they're not going anywhere. That's the thing. It's not like, oh yeah, they hung in there. No, they're super profitable. So what happens in a mutual company, a life insurance company that's mutual that you can't own stock in, the profits go 3 places. One, they put the money back into the company and make things better for the customers.
For a change.
Yeah, because I didn't know where it was going. I didn't see the future of so a lot of what drove me was money. I mean, growing up poor, that's what you want, right? You want money, right? You don't got it, that's what you want.
Happens to a lot of people.
Exactly. And so when I was working at Johnson's, it was trying to figure out, I guess, I was in a pipe dream of taking that, being able to work with the owner and taking that company to places that we couldn't really do it because it wasn't managed properly. So
you had a growth mindset. You were looking to expand and change, and I mean, you were young and hungry.
Yeah, but I guess I've always had really a growth mindset, which is weird. Because when I was a kid, I shoveled driveways, I mowed lawns for money.
Got it. Yeah.
I would do, just do odd jobs. And at 10 years old, I was making floor mats out of rubberized. I think I told you about that.
Mats with the name Matt on
yeah,
there.
right.
Mattception there.
and out of tires, right? So there's some weirdness going on there. So I worked for my best friend's uncle at the time. I was 10 years old, so that's 4th grade. And he had a company where he'd go around to all these old tire companies and buy used tires, cut the sidewalls out, and he had a machine that he would run the sidewall of a tire through a machine. It would cut, and it would cut these long strips. You'd cut the strips, and then we had these prongs, metal prongs, that you lay the piece of rubber down, because they're all punched holes too in them right now. And so you run a piece of strip and then a piece of plastic, and then you put another piece down, and you offset the plastic pieces. So it's those rubber old school mats that you see, right? I made those. And I made enough of them to buy my own bicycle, my first bicycle.
10 years old, Matt's
dude.
buying bicycles
The
by
Huffy
selling
Baby,
mats.
$200 check. And guess what else I got? Vanilla Ice's book. Oh my God! Yeah. I don't remember reading it, but
Stop collaborating.
yeah, man. Yeah. So, oh my Lord.
So
yeah.
this Johnson's Tire Company wasn't growing to the extent that you wanted to. You had a growth mindset.
Well, they were growing, but they made some bad business moves, and now the company was in trouble, and there was no way of getting out of that trouble for the company.
So was it you saying we're not going in the same direction? I want to leave. Was it? Oh, I see. There's trouble in
I was looking at leaving. Okay, I was looking for opportunities to leave. What that was I didn't know. I don't know what that was at the time. So I'm just looking for opportunities to leave. The relationship had fallen apart between me and my friend and the owner, and so we ended up parting ways.
Got it. So you think that was one of the big, we'll call it catalytic events that got you to where you are now, was definitely leaving Johnson's Tire.
Yeah, man, there was a big transition there. So big, and this is probably a topic for another day in conversation, but there was a big personal transition for me there that occurred there, because that dude was a really big mentor to me, and I learned a lot. So he was very important to me in my world.
Right.
It's, I didn't grow up with a dad, so to me it was a bit of a mentor, a father figure, a friend.
Yep.
And he was older too. He's probably 50 now, and I'm 37. So, but he was a lot to me. So separating now and not having that relationship anymore, I did learn.
So it was a big hit, a big decision.
It was a big hit.
Personally, professionally, like all levels, it was a hard thing to go through.
Yeah, Alex, another thing back to it, and you're hitting on it, is more, I guess it was a bigger deal than I really think about and put more emphasis on, because it's just, for me, I think about it as it's just what you got to do, man. Like, you got to keep moving forward.
Right.
And I don't know where that comes from. I don't know what that is. Yeah, I mean, we could probably dissect it, and I'm sure there's way smarter people who know about it. But
someone's gonna comment and be like, "Yeah, bro, it's easy."
Yeah, but I mean, what else are you gonna do, right?
So now you're at this low point. You're leaving Johnson's Tire Service, looking for opportunities. Like you high at Johnson Tire Service, like you're getting close to ownership, down to low where your personal relationships are failing and the professional relationships are failing. What did you do?
So I did what I thought was the best smart move. Go back to what I know and shake the trees that I know or familiar with.
So what is
relationships? So I went back to Costco. Okay. So I got hired on with Costco. That's where I met your dad.
Yep.
We got hired on at the same time.
Yep.
And so I'm a 32-year-old guy coming into Costco. There was a temporary supervisor position open. They put some 22-year-old kid in there. And so I quickly saw within 3 months of how things go there. And that wasn't going to work for me. I'm a 32-year-old dude with 3 kids. I got to support my family, right?
Right. And not even that, I think, like you might have saw some things in there, but you literally just talked about how you have a growth mindset. And in that system, I mean, my dad works for Costco still, and he's absolutely grown in there. But it's just not, that system's just not the one for everyone.
Yeah, it's not the type of system that, I equate it to football. And I'm a big football guy. So here's what I talk about. You can take a guy, he gets drafted. Larry Foote, right? Do you know who Larry Foote is? Played with the Pittsburgh Steelers.
Yep.
Phenomenal football player.
Got it.
Do you know who he played for before that?
No idea.
Right. Exactly my point. I think it was the Bengals or the Browns, but he's terrible.
Right.
But all of a sudden you take this guy, same football player, and you put him into a system that's best for him, and all of a sudden he's a Pro Bowler, and he's like some amazing football player. And I know maybe a lot of people know Larry Foote, but I just use a small microcosm of an example.
I bet you he enjoyed that team or that scheme better too, and that's why it was more successful. If he likes to rush the quarterback and you put him in a scheme where he's dropping back, he's gonna hate it.
Well, it's more important than that too, Alex. It's the culture. It's the coaches.
Well, yeah.
It's the people around him. It's all of that.
100%.
And so for your dad operates at a super high level in that world.
What I was getting to is you enjoy the system, automatically you're going to work harder than everybody else,
Yep.
which automatically means you're going to
Yeah,
succeed
so-
more than anybody else
so-
because you're willing to put more hours in.
Right, and I think that you bring up a good point here. It's two examples of, because your dad has a growth mindset too. I love your dad. He's me and him, and I love the guy. And so I'm a growth mindset guy too, right? And so we're both hard workers.
Right.
But you can clearly see that you have to put yourself in the best position to be successful. No one's going to do it for you.
Right.
And so in the Costco system, he's done very well and will
100%.
continue to do very well. For me, didn't fit in that box.
So what was the decision after Costco? Like 3 to 4 months, you were like, ooh,
Yeah,
not to move. Where are we going?
Well, no, I wanted to. After 3 months, and I got that turned down.
Okay.
I go, okay, well, what's the next opportunity? Right, and so then the next one was go to what I know inside that world, which is the tire world.
Okay.
And so I went to the tire world, and so you're dealing with corporate rules. Again, I have a hard time with that because when I come from the auto and tire world, it's very gray, right? We do a lot of we try to make solutions happen. And then when you switch over to a corporate regimented world, if the solution doesn't fit in the box that corporate has outlined in a procedure, you can't do it.
Which is good sometimes.
I think it's very good for especially how Costco is set up when you have the person who wants to make the $50,000 a year job and has nothing asked of them more than that.
Yeah.
And so, which is perfectly fine. I think that's, because I have friends like this. And what I mean by that is I have a friend, Jesse, who is happy making his $42,000 to $50,000 a year, going home, working his 9 to 5, and taking his 2 weeks a year and playing video games and doing whatever the hell he wants to do on his free time.
And at the end of the day, that's what's most important. If I don't have a growth mindset and I don't mind living in a trailer and I can make $30,000 a year and take a week off a year and that makes me happy, it fills my heart and soul, more power to you.
Right.
Happiness is the end game above it all.
Exactly. And it's taken me to this age to kind of look at my friends that way as well. Because I had a bad, I think, outlook towards that, where it's like, why aren't you trying to better yourself? Why aren't you trying to do more? Why aren't you trying to do this or do that? Or why are you doing this? You know what I mean?
Right.
Why are they not putting themselves into the best position to succeed that they can in all facets of your life?
Let's get real philosophical. What's success, though?
Success
For you, it's business. For me, it might be personal.
Well, see, that's the thing.
For some, it's a stay-at-home dad.
You're right, Alex.
Happiness at the end of the day.
And that's where my mindset has changed, because my definition of success is different from yours, different from the person next door, and different from my friends. And so you can't take your own thing and put it onto somebody else. You have to take responsibility and accountability for yourself and your own actions.
Okay.
And so there's a lot of the stuff that I've learned since 2015. Not that I didn't know a lot then, but the growth has been geometric. So it's just gone up.
It's an insurance term.
Yeah.
You're starting to squeeze it in. We're getting close to the insurance world.
Well, so
geometric growth here.
Okay, so December 2015, I'm working at Costco. I'm in the marketing department. So I moved from the tire department.
Okay.
I got denied for a supervisor position at another location for the tire department, which at that time I could have ran with my eyes closed. I could have ran both locations with my eyes closed, coming from Johnson's Tire Service.
And it sounds like that was the best gift anyone could have ever given you.
I think so, because I would still be there right now if I would have got that promotion.
Which might have been good, but it seems like you're real happy going in the direction you're going now.
Well, I'm more than happy. I'm fucking thrilled, dude. Like this is life changing for me and my family and my world. And so 2015 December, I'm standing around handing out Costco brochures for Costco travel for flyers. That's because I got moved to the marketing department. I applied and got to the marketing. Well, I had done that because they would get out of the location and go talk to people and to businesses. Well, I missed that boat. So I got stuck in the tire shop because they needed a guy there because it was fall in Alaska. I moved from there to tire. The rush was over in that world, in the tire world. December came, I was marketing. A woman by the name of Sherry stopped me and asked me if I'd be interested in doing something else. And that's when New York Life came up.
Okay.
So I had a meeting with a managing partner at New York Life, figure out what the hell that is, did some assessments and tests.
So let me stop you there. Why? Not why did she ask you, But why did you decide to say yes? Was it something you've always been passionate about? Was it just another opportunity because you were looking for it? Like, what was the reason?
It was an opportunity to make money. It was an opportunity to do something different. That if I stood there making $13 an hour, handing out Costco travel brochures, I was going to shoot myself in the head.
Okay.
So it was the most brutal month of my life. One of the most brutal probably when it comes to work. It was terrible. I just couldn't do it. And so maybe some people can. That's what they're built for. I just wasn't. And drove me nuts. And so I saw the opportunity. I saw that there was a challenge. I'm a guy that likes to learn. I'm a guy that likes I'm a competitive guy as well. And so get into a world where I didn't know anything really. And I loved finances and I loved that world. Here was the avenue into it. Right? Because I never wanted to go into real estate because of those trials and tribulations with that, and so I got hired on with New York Life.
Okay.
And so the guy that was my managing partner, I had worked with at Red Robin when I was 17, 18. If you can imagine that. Like this is Alaska. So one degree separation, man.
Always. So it's the craziest thing.
12 years later, 15 years later, me and this same dude, he was a cook at Red Robin. This guy's now, I bet he was making $250,000 a year as a managing partner. So he's now worked his way from being a schlub from Houston, Alaska, to a cook.
Schlub. He says a schlub.
And to now being...
In the most loving way that I can say. In the most loving way.
I mean, I'm just some, schmuck from some trailer park in Anchorage, Alaska, dude. So he's worked his way up, and I learned a lot from him. And I learned a lot about the industry. And so I worked about 2 years, but it's very difficult. It's a very shark world. In the New York Life, I guess, method of insurance, it's very difficult. It's 100% commission, which you're familiar with.
Very much real estate.
Limited support system. The only way to make money is to sell policies. And so I learned a lot. Like that's where I got most of my education when it comes to life insurance and the investment world.
Because at the end of the day, in order to sell something, which is 100% of your income, it has to be something you know and that you believe in. So
it does.
100% makes sense why you would dive deep into learning your craft, because that's the only way that you'd be able to sell it. And
right, and I have to believe in something to sell something to somebody. So me personally, I can't just offer you this soda because it's here. I have to believe in it. I have to have tasted it. I have to know it's good. You know what I mean? And so when it comes to the financial side of things, it's very important that the relationship is there. That I have a relationship with customers, with clients, and that they trust me.
Okay.
Because it's very important to me. And that was the world of New York Life. That wasn't the world of New York Life. It was write 100 policies a year for the next 3 years, and then just work your book of business. Because after 3 years, you become an established agent, and you're technically on your own.
Okay.
So 3 years, you're captive. You're underneath the managing partner. He's training you, getting up to speed. Supposed to be. Doesn't always happen. And then 3 years, you should have enough business to go out, be an exclusive or an established agent.
Okay.
Now you're a business owner.
Okay.
And now you work your book of business and go that route. But to get to 300 policies in 3 years is all about transactions. And that's where I failed. That's where I wasn't good. I'm not good at just the transaction and let's just churn. On top of the fact that it's 100% commission and money's going on and money's coming off and you're worried about if you're going to pay rent, if you can feed the kids and all of that stuff, while also, hey, let's build a relationship and let me try and sell you something, when all the while in my back of my head, I got bills to pay, so all I'm going to try to do is sell you stuff.
So it was inauthentic.
It became inauthentic.
Maybe not for everyone else, right? Because different situations, and I don't want to bash New York Life because I know they're a good company that does help a lot of people.
They are a good company. They're a great company in the fact that how long they've been around and how much money and training they put into their agents.
Right.
Like that's no joke. Dude.
But for you in that specific situation, it was hard for you to say, hey, buy this pad of paper, but in the back of your mind, you were like, I need you to buy this so I can feed my kids.
Exactly. And so, and they have an 80% attrition rate.
Okay.
So within 3 years, 80% of the people they hired 3 years ago are no longer there.
Okay. Same thing, real estate. Same way.
Right.
That 100% commission world.
Right.
Really.
So clearly, they're only getting the people that can really manage in that world.
Right.
Not the not the people who are on the fence or on the cusp of it. So, and what helps in that world is having a spouse who makes money, who can pay the bills. If you have that, then you don't.
That
worry
is
about
one
that.
specific situation that I would agree with you and disagree with you, because there's other situations too where you eat shit. You take your $60,000 a year lifestyle and turn it into a $30,000 a year lifestyle.
Right, and now that's what I've done.
Right.
So I worked at New York Life. A very good friend of mine helped get me a job at State Farm.
Okay.
And so I was looking on the internet and I saw that Eric Christensen State Farm came up.
Got it.
So my friend Caitlin worked there. She's been working for State Farm for quite a few years, and she's actually getting her own agency now too. So good for her. So I saw that he was hiring, reached out to her, got the inside scoop that he's looking for a life insurance guy. Lo and behold, guess where I come from, right? I went over to the office, checked it out, loved the vibe, loved the feel, met with Eric. Couple interviews, negotiated my hourly rate, met with his wife, interviewed, did dinner, and then got hired.
Okay.
July of this year, 2019, was my second year with State Farm. And so the first 15 to 18 months, all I did was life insurance. That's all I've done.
Okay.
So I meet with customers, talk about what's going on in the world, and then we talk about life insurance and where that need is and what that looks like.
Right.
And then I got my P&C license recently this year, and now, which is property and casualty. So it allows me to talk about homes and auto insurance and everything that goes along with that.
100%.
And so I got that earlier this year, and then I started having more in-depth conversations with customers. July of 2019, this year, I got a random phone call from Beth Libby, who asked me if I wanted to talk about taking over her book of business. She said my name came to her highly recommended. And so I was blown away, and I'm like, yeah, what the hell does that mean?
At the very least, you have that conversation. Even if you're 0% interested, you have that conversation.
Yeah, because
you never know.
Because here's the thing, and I want people to really understand this, is I wasn't looking to leave. I wasn't looking for another opportunity. I didn't have resumes. I didn't even have a resume. I didn't have anything out there. I was just doing what I could, and so.
But you were finally put yourself in a position from the whole story you told us, from the tire shop all the way down, to where you were doing something well and something that you liked.
Yeah.
You put yourself in those two boxes, opportunities automatically come your way.
Right.
Automatically.
Yes. And so I wasn't sure about taking this opportunity, what that all meant. So I talked to her for a little while, about an hour on the phone, got with her and the sales manager the week after, got a little more information on what it is.
Yep.
And so what it boils down to is she wants to retire. They gave her the option to choose her successor. She reached out to probably all of her connections.
Which, in 18 years in the Valley, 1 degree of separation, Beth Libby knows a shit ton of people.
Lots of people, man.
Everyone. Real estate, insurance, all over the place.
Yeah, she's been the president of the Wasilla Chamber of Commerce.
Right.
She's been in charge of the Valley Board of Realtors on that. She's a very, very good painter, and she's been hooked with the food bank of Alaska for many, many years.
So all
she's
of those
very
people.
welcome. Yeah, man. Like, she's super sweet lady too. Just one of the most nicest ladies.
The most nicest.
Just the most, yeah, just like
so good.
Yeah, just I don't know how else to, like, just the most nicest lady. You know, she's just so sweet and nice. And so, there was probably a lot of candidates, potential candidates to take over her book of business, but she talked to someone who said that I did well, and so what I come to find out is that me and her do business very similar.
Okay.
Relationships.
Okay.
That's how we do business. That's how she's built her book of business, and that's how she's continued to maintain her book of business. And so what that means is we just swap spots. So I'll have my own location, my own building, my own office.
Okay.
I have an assistant, Trina.
Okay.
She's been with Country Financial with Beth for 6 years now, so she knows the whole system, how it works.
Got it.
So am I letting her go? No, I'm probably going to pay her more money too. That's what you do for people, your employees, right? And so, I think a lot of the things that I've done in my life has really prepared me to take on this venture. Okay. I know everything I can know so far from my insurance experience with State Farm and New York Life, how to run a business and how to deal with people. I take from Johnson's Tire Service. So I learned a lot about business. I was in charge of the financials for my location, hiring and firing and payroll, and how am I going to increase sales and training and customer service problems, and I mean, there's just so many things that I got to do there, and so I really, really appreciate and am super grateful for that experience, because now I come in here having one employee,
right,
and I don't feel overwhelmed. I'm not scared of it.
Well, you've been preparing for it the whole time.
Yes.
Right. You have the knowledge. You have the experience. You have the management. Now you're kind of putting all the pieces together.
Because I had a small business before in my 20s. I had a small construction business. So I worked 5 years for Spinell Homes. Okay. I was one of the largest home builders in Alaska for quite a few years in the early 2000s. I separated from them, and I started a business of doing decks and fences and kitchen cabinets and all that stuff. But I wasn't successful. Why? I was terrible. I was 26 and was an idiot. I don't know. You don't know. Yeah. I didn't know business. I didn't know how to sell. I didn't know how. Nothing. Nothing.
Yeah.
Nothing. So to go from an employee mindset to an employer business owner mindset is very different. There's a line you have to cross.
Right.
And so I'm crossing that, and it's not. And I'm at a point in my life where it's comfortable. Like I'm not scared. So October 1st is when I officially become a country financial agent.
And at the end of the day, that's not a jump everyone's willing to make, because you have to love it, right? It's not for everyone. Some people, I'm going to take Gary Vaynerchuk, uses it all the time, would make way more money being the 17th person hired on at Facebook than they ever would be being the number one guy at whatever business venture.
Yeah, now you're talking about self-awareness and people trying to
100%
put themselves in the right position.
You have to love what you do, most important. You also have to be good at what you do, though.
You have to be good.
Another key factor there.
Yeah.
And you love it.
I love talking about finances and wealth and money.
The growth mindset, you love that.
I do.
But the construction, wasn't really the spot. And I think that's why you weren't successful. And then you took this route of learning and tasting and figuring out to get to where you are today.
Right. And I don't think that being agent country financial is my last gig. It will change in 5 years or 10 years.
We have talked about this so many. How old are you?
37. So I'll be 38 in December. Jesus.
Jesus. You are not even halfway there. You're going to live another full life. Plus.
That's
so much time. So retiring at 60 is ridiculous.
I'm living to 100, bro. I'm living to a healthy 100.
It's not unrealistic to think you're going to live to 100 or more and be able to work it up until you don't want to work anymore, especially if you're doing what you love.
Well, there's another thing too, work, right? Work and retirement. And this is a concept, because it's in my world, that I've been trying to wrap my head around and come and formulate my perspective on it properly. Because I don't believe in I don't want to say belief. I think that the current retirement system is fucked up. Okay. And so looking at retirement, I don't think that people should hang it up at 65 and then just watch Golden Girls for the rest of their days, right? Sit on the couch. So I think that people should stay active doing stuff forever. So what I always ask people is, let's not use the word retirement. Let's think of, what would you do with your life if you didn't have to work for money? And so that's a lot of the times the question I pose to people, because then it gets them thinking outside the box. Like, cool, great, you've been a heavy equipment operator for 30 years and you've worked out for the 302. Well, you're 62, what do you want to do now?
Yeah.
Not sit around all day. Let's do something. Do you want to be a consultant? Do you want to go work at Walmart? Do you want to go work at the hunting store? Like, something. Because of how, what is it, like 66% of people to retire get dementia and Alzheimer's?
Because they stop.
They stop doing it. And I know when I worked at Johnson's Tire Service, my buddy's dad, who was retired, high level, he was a president for a company, high level guy.
Yep.
But he was 70, in his mid 70s at that time. He was involved, helping him with financials and stuff like that. Because I think that we discard our old people in this country instead of revere them and lean on them based on their experience and their life. Their life experience. You're 70 years old, dude.
Right.
You like, how much stuff have you done?
I'm 25, about to be 26 on Saturday, by the way. Look at that camera. It doesn't even see it looking straight at you. How long has that been that way?
I don't know.
We've been getting deep. 26 though. I'm about to be 26. If you're 70 years old, you've lived literally 3 of my lives. Pretty close to it. My math is a little off there, but 3 of my lives you've lived.
And people lose perspective on that type of stuff.
And you have a lot of lessons based on mistakes and successes.
I love talking to old people. Old customers
why do you
are
think
my
I
favorite.
invited you onto the show?
You know what I'm saying?
No, I'm messing with you. You're a baby still. You're young. We talked about it. And all I want to do is get people to act like they're retiring now. Exactly what you were saying. Where the money aspect, don't say retirement. But if money was not a factor, what would you do? Let's figure out a way for you to do that thing.
Right.
That's the most important thing in my world. That's why I want to help people, and that's why I want to talk to you today about this. Because real estate is one of the easiest ways to break through the mold and be able to set yourself up to where, like, if you have yourself set up where you're not paying your mortgage payment, for a lot of people that's $20,000, $30,000 a year that they're flipping into, what else can I do?
Yeah,
you know what I mean? You can live the same quality life for $30,000 less if you make smart real estate investments.
I agree. So what we have to talk about before that, though, is the financial situation of people overall, right? So we know that. Well, what I mean is, I think that real estate's a great investment as an income property, as something that creates something for you.
Okay.
And so people, because I'm still on the fence of owning versus renting. So
you're on the fence about it, or you're meaning you specifically are renting?
I'm renting, right?
Yeah,
renting.
yeah, yeah.
And so will I go out and spend $350,000 on a house? Probably not. Why? Because I think the value is in buying something, an income property. And so before people talk, where the value is in real estate, we've talked about the savings rate of this country, because you need money to buy real estate, right?
Yep.
So how do you get the money? Well, currently the savings rate in this country is like 6%. So people, save 6% of their income, which is, it's probably less than that, because that's offset by massive mortgages, car loans, and student loan debt, and credit card debt.
Got it.
So we have to talk about debt. So none of people are saving, because you need some cash to buy real estate. Doesn't matter what you do and what piece of property. Whether you're a first-time home buyer, you need that 3.5%. Well, that 3.5% can be, $5,000 to $20,000.
There's some programs where you can get in for zero down.
Sure.
For the most part, though, you need 3.5%, probably plus an extra few thousand just to get through the process.
Right.
So you're looking at 3.5% of 100,000 is you're looking at 5,000 to get into a $100,000 piece of property, and in Alaska you're probably looking at 7 to 10,000.
And then we don't talk about beyond saving for closing costs and down payment.
Right.
So when you're renting and your faucet breaks, what do? Yo, come fix this. It's broke.
Yep.
Right. When you buy a house and your hot water heater goes out, who's on the hook for that? Right. Right. So, but everybody just doesn't spend all their money on getting into this place.
Right.
Now all of a sudden you got a mortgage and something breaks and blah blah blah. But now you're responsible for everything, and people don't have the money in place for that.
Right.
So then where do we save money? Let's talk about savings, right? Well, there's always the normal place is the savings account, right? But what do banks give you? 0.25%
interest.
Right. Yeah.
Return?
Yeah.
Yep.
Right. So because we want our money working for us. If we're saving our money, we still want it to work for us.
Yep.
Right. And I think that's what people miss that point, maybe in some respects. And so we want money to work for us. And what does that mean? Well, if we put it in the savings account, it's not going to earn anything. And if whatever it does is taxable. Put our money in a money market account. Well, it stays liquid, but there again, how much our money market's paying? Well, you can maybe find one at 2%. So let's say it's at 2%.
Okay.
And let's say you have $100,000 that you're going to put in there. First of all, it's a lot of money. Not a lot of people have that, but I like using round numbers. Well, 2% interest on $100,000 is $2,000. How much of which is taxable? 100%. 100% of your interest you just earned on this $100,000 is now taxable.
Okay.
So it's taxable income.
Okay.
Right. So how much money?
And at 2%, you're not even meeting average inflation rates.
You haven't beat inflation. Inflation's 3%.
Right. Average changes, but average.
Yeah. So
overall, you're still losing money while your money's in a money market account.
Exactly. And so what people don't understand with inflation is that the dollar you have today will not buy the same shit that it's going to buy tomorrow.
Right.
That's inflation. right? My dollar today will buy this Snickers, and tomorrow the Snickers going to be $1.09.
Right. At 3%, your dollar next year is 97 cents.
Yeah.
Then it's 92.5 cents.
And if you really go back to when we got off the gold standard, let's look at inflation really, and it's just plummeted, right? So we don't have the graphs and all the information, but you can definitely research that and find that out. It's easy information to find.
Yeah.
So money market.
All you're saying is saving. You need to be able to save to get into a house, which I agree with you. And I have this conversation with all the clients that I talk to of, first of all, let's talk about you getting into a house and getting approved for the loan, because that's the most important thing, and establishing a payment that you're willing to pay for. Then once you have that, the bank's going to give you percentage and numbers and stuff. They're not going to look at your situation. Then I'm going to sit down with you and say, it's you and your wife. You need 4 bedrooms? Or do you need 3 bedrooms? Right? Because you're 26 years old. I need 2 bedrooms. One for me and one for my baby.
Right.
That's it. I don't need an extra office. I don't need a 4th gym. I don't need a 3-car garage.
Don't need the yarn room.
Right, because saving that money at the end of the day is going to be able to flip me into getting that 4-bedroom at a later date if I decide that's where I want to be. But then it's going to be in a better position where I have a nest egg. I don't know why I keep moving this pad all around, but it feels real good. I'm fucking...
Yeah, so
making that smart decision, saving for it, and making a smart decision with your money.
Okay, so then how do we? All right, so we got a savings account, typically where people save it. Money market account, fantastic. CDs, again, we're working at the same interest rates, maybe a point higher than what money markets are. However, your money is locked up.
Right.
I'm not a fan of CDs. I will never suggest one.
Okay.
I never really do. There's way more better places to put your money into.
One of them mo better places.
Mo better.
It's mo better.
You know, at this point, here's how much I don't like CDs. I would just say put more money into your 401k, and I hate 401ks.
Hate's a strong word.
It's pretty close to that. It's a pretty bad industry and product.
Okay. Overall. What are you getting here, Matt Witwer?
So
tell me about it.
With real estate, so what we're getting to is where's the place to save money? Well, that's where one of the oldest financial tools on the planet Earth comes into play, and that's whole life insurance.
Okay.
And so typically life insurance is I got kids, I got a mortgage, I got a wife, I got debt. If I would die, I want my family to be taken care of.
Got it.
Right. That's where term insurance comes into play. Right.
Yep.
You're 26, you have $500,000 in debt, and you make $75,000 a year. That's about what you can afford, right? Term insurance is super inexpensive.
Okay.
So anywhere from $20 a month to maybe $100, whatever, depending on your age and whatever.
Okay.
So not saying that's it, but that inexpensive overall speaking, right? People spend way more money on their damn cell phones than they do on any of this other stuff.
Okay.
Right. So let's say it's $50 a month for term insurance, right? $1 million, that's what you got. Okay.
Okay.
Well, 1% of term insurance pays out. So most of the time, 1% of term policies pays out.
Okay.
So they don't pay.
Okay.
Right. That's not. They're there in case something happens during when you got 3 kids under the age of 10 and you got mortgage and you don't want to leave your wife behind with all this stuff. Okay. So there's term insurance. Well, the other side of life insurance is whole life insurance. And when it comes from a company, and so when it comes from so most life insurance companies, the best ones are mutual. What that means is they're not stock companies. Okay. So stock companies like Facebook, Google, Amazon, all these companies, you buy a piece of stock and I own a piece of Facebook now, right?
Right.
However, what that means, those companies are for profit, which isn't a bad thing, right?
Okay.
But they're there to give money back to their shareholders.
Okay.
In the life insurance world and life insurance companies, why it's been around, and here's another question to ask yourself, how long has these companies that are in the stock market been around versus how long are these companies these life insurance companies been around? Life insurance companies have been around for 200 years, dude.
Yeah. I mean, there's companies that have been around for 200 years too.
There are, but there are far more
life
insurance companies who've been around for 120, 130, 170. You know what I mean? Long time versus these companies. And they're sustainable. And they're not going anywhere. That's the thing. It's not like, oh yeah, they hung in there. No, they're super profitable. So what happens in a mutual company, a life insurance company that's mutual that you can't own stock in, the profits go 3 places. 1, they put the money back into the company and make things better for the customers and the employees alike. 2, they put the money back into their savings account because what people don't know with life insurance companies, they have to have dollar for dollar in the savings accounts, and dollar for dollar for how much life insurance they have out.
Okay.
Something to that effect. They have to have a certain level of reserves.
Right. So that way, if they have to pay out 200 people, they have that cash to pay out 200 people right away.
Absolutely.
Got it.
Versus the banking world, right? Put your money in the bank, it's going to save. They use a fractional banking system. So what that means is your $1,000 in the bank, you actually are only going to get 15 to 20 cents of that money on the dollar.
Right.
Where
that's what they have on reserves, 15 to 20 cents of your $1,000.
Right. They loan the rest out.
Right.
Right. So you have a life insurance company now that pours money back into the company, puts money in their savings account, and oh my gosh, we got a little sugar left over. Where does that go? It goes to me and you.
Okay.
If we're policy holders. So in the life insurance world, specifically whole life insurance, they receive dividends.
Okay.
And so, and companies been doing this since they've...
Right, yeah, dividends are very common.
Very common. They're not guaranteed, so that's the big disclaimer, right? Big disclaimer, not guaranteed.
It's based on the success of the company.
Yeah, exactly. And however, it's a return of premium is what it is. So how they figure it out is they say, because life insurance companies work off of mortality tables. They want to know how long you're going to live.
Okay.
So if Alex Mays at 26 years old is supposed to live till 84, they base your price off of that.
Got it.
But if you die this year, you fucked up the mortality tables, right? So now they either paid out more money, or if you don't die, right? Now you're 84 and you don't die when you're supposed to, they have more money than they were supposed to give out. What do? That's when they hand out dividends.
Got it.
Right? And so life insurance has been doing this since they've opened up. Since they started. And so with life insurance policies, the money that's in there grows tax free. So you have cash value component to the whole life insurance. That's where I'm getting at.
Okay, so let me break this down because we're starting to get a little deep. I want a whole life insurance policy. It's something I pay into monthly, right? Based on the mortality table and everything. That's how they determine
your health.
What you pay into.
A lot of your health.
Right. Then it's let's say I sign up for a $100,000 whole life insurance policy today. Tomorrow I die. My family gets $100,000.
Tax free.
Correct.
Yes.
Okay. If I die at 84 years old, my family gets $100,000
or more.
$100,000 is guaranteed though.
Yes.
Right.
No, all of it's guaranteed.
Well,
the whole face amount is guaranteed.
Okay.
The face amount is guaranteed. So at 84, I don't know what that number is because we've had. When you have cash value in a whole life policy, you have to have a certain level of death benefit over the top of it. That's how we keep the cash value in life insurance tax free.
Okay.
So, and that's why I say it's the best place to save money and one of the most sound financial tools.
So you're adding cash value to it by paying into your premium every month.
Yeah, it's going to build cash value on its own.
That's going to grow in cash value, and you have to have that $100,000 has to be a certain amount over the cash value.
Yeah, so let's say it gets to $30,000 in cash value, your death benefit will go up.
Got it.
With it automatically.
So that way at 84, if I buy it at 26, spend it or die at 84, that's why it's not going to be $100,000. It's going to be based on what that cash value currently is.
Yeah, that cash value is going to help push that. And depending on how your dividend is too. So the great thing about life insurance, you can choose how you want your dividend to come at you. Okay. And what I mean by that is, if you're paying $100 a month, you can say, "Hey, I want my dividend to reduce my premium." Right? Pretty simple, right? You pay $1,200 a year. Now you pay $1,000. Right. The second option, or not the second, but another option is you want cash. So your dividend that you get every year, the life insurance company's going to
money.
Yep, just boom. Problem is, it's taxable.
Okay.
So there's a taxable event. That's what we want to be cautious of because we want to eliminate the liability of taxes as much as possible. Okay. Right. So what's the next option? Well, I can buy accumulated dividends. So what that means is we're going to take the dividend that we're going to send to you. We're going to put it into a separate account, and we're going to guarantee a certain percentage rate on that account, and it's going to grow too. The problem with that one is, again, there's taxes. Okay. So if you're now 40 and you want to pull money out of that particular bucket, you're paying taxes on that money because they've guaranteed an interest rate. Blah 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 blah. Right? I think we all understand that part. Yep. Then the fourth one is paid up additions. And so this is the really cool one. This is how we can really make the whole life policies grow and create that bucket of cash of cash value. Okay. And so we do something called buy paid up additions. Okay. So what that allows us to do is to dump more cash into a life insurance policy, and
take my dividends and put it into the cash value.
Yep. So I take
Got
my
it.
dividend, and it's going to buy me a little piece of life insurance, and this is going to go on top of my policy.
Yep.
And not only will my first policy get a dividend, but so will the second one, and so on and so
And
forth.
then you keep on
So I'm paying my $100 a
addition,
month.
addition,
Yep. And then what else
addition.
that paid up addition allows me to do is, depending on how I create, let's say it's $5,000, right? I can tell that paid up addition that I want to be able to drop in an extra $5,000 a year of cash into this policy. So now you're putting your $1,200 in, and then you just dumped in $5,000. You can see how we can start growing some money,
Quick.
right? And oh, by the way, life insurance has averaged about 4% returns.
So
Net.
the $1 million question is, I'm 26 years old. I signed up with Matt Witwer Country Financial to run a whole life insurance policy.
Yeah,
for
and
me.
you can do it through a bunch of different companies. But let's say you come through, yeah.
Right? And I'm 26 now. Let's call it 32. 6 years later, right? That's math, right?
Yep.
I want to buy a house. How do I use my life insurance policy
Perfect.
to buy a house?
So so then you're 32 and you want to pull cash out. Let's say you have 50 grand in there, but you need to have 50 grand in there, right? So let's say we pull the money out. We buy a house, right? Buy a piece of property.
So with that $50,000, I can pull it out.
Yep.
Tax free.
Yes.
How do I pay that $50,000 back?
Yeah. So that money comes as a loan. It's not your money. The life insurance company gives you the money as a lien against your money, your cash in your life insurance policy.
Okay.
Right? And so
So while I'm paying that back, I have this $50,000 that Country Financial's holding.
Yep.
I take a loan out of my own $50,000 to buy this house.
yep, your life insurance policy.
The principal goes back to the life insurance policy. The interest goes to Country Financial. Yes?
That's correct.
Okay. My question for that part is, I'm not allowed to get a loan when I'm going through a bank to get another loan, am I?
Yeah, because this is a loan that is not on any books. It's between me and you. It's between the life insurance company and you, right? You don't have to get a credit check. You don't have to ask for permission. You don't need to
Because at the end of the day, it's your money.
Exactly. You don't need to get the board of directors' permission. All I'm going to do is make sure we don't create a taxable event, and we make sure we put the money back in there. And so this is where let's go back full circle. Now this is where I talk about savings. If you are, and here's a real simple rule: there's no take 20% of what you earn and save it,
Okay.
and then spend the rest.
Yep.
Right. So now we got the 20%, and we're putting it into stuff. Right. Let's say we're putting this life insurance policy. Well, 5 years from now, 7 years from now, when you're 32, you go to pull the money out. You've had 7 years of established habit already. Right? So you're going to continue to save your 20%.
Right.
And so now you've pulled money to buy this piece of property, and we're going to pay the loan, we're going to pay the money back into the policy, because here's what people don't understand. Your dividend and the earning ability of your life policy is not affected by the loan at all, negatively, in any way, shape, or form.
Yep.
So there's the other positive thing, right?
Okay.
We're utilizing savings, tax-free. So now I just put in $50,000 of my income, and as everybody knows, if you've ever taken money in a 401k, all that
It is
money.
not tax-free. Fool.
No. So your own money is taxed, right? Here's another reason why I don't like I'm not a fan of the 401ks, but you take this 50 grand out, you buy your piece of property, and let's say it is an income producing property. Well, now you can pay that loan back and pay that money back even faster, and recoup your money, your savings bucket even faster.
Okay, so let's go. We're going to go full picture right here from square one. I come, sign up for a whole life insurance policy for you. First benefit is now I have the death benefit. If I die tomorrow, my family gets $100,000, arbitrary number. Right?
Sure.
Okay.
And for that piece, we would do a term policy, specifically to cover wife, kids, because it's so inexpensive.
Okay.
And then we'll put the savings portion into the whole life policy.
Okay.
And we'll design that for the best.
Okay.
However it would serve you best.
So I come to you, get my whole life insurance policy. I'm 26 years old. I pay $100 a month for
Sure.
it. Okay. 6 years later down the line, I'm 32 years old. My family's been living in a fourplex for 6 years. Now I want to buy a single family home. So I don't need cash value in my bank account because I have cash value in my life insurance policy that I can borrow against for the down payment.
Right.
Right?
Right.
And then we borrow against the money. It's a loan out of our own account. We pay the principal back to ourselves, and we pay interest to Country Financial for running the loan for us.
That's correct.
Right? So then 6 years later would make me 38. I want to buy another house. I've paid this loan back. Now I don't have $50,000. Now I have $100,000.
That's right.
Or $150,000.
Yes, sir.
Now I can buy an investment property from my insurance policy
As a down
and
payment.
say no bank.
Uh-huh.
Right? $150,000 investment property is easy to find. No bank. I just bought a property using my life insurance policy as the bank, as an investment vehicle.
That's correct.
So now, when I'm paying that back, I'm paying Country Financial interest, but I'm paying myself this $150,000.
Right.
Oh, by the way, someone else is paying that mortgage payment for me.
Right.
And that's where we're starting to compound investments
And
now.
tell me the difference of putting that money there or into your savings account at Alaska USA, Denali, Wells Fargo, blah, blah, blah,
No
blah, blah.
taxes.
Exactly.
When I pull that out, it's no taxes. The
Well,
only charge is that interest I'm paying you for running the loan.
You never get tax on the growth unless you totally killed the policy or we put too much cash into it.
Okay.
Okay, so what happens if you put too much cash into a life insurance policy? They created a law, the government created a law in the 80s because if you ever want to know how laws are made, just figure out what rich people do. Find out what the rich people are doing, and then there'll be a law that stops
And
the
the
rich people.
government's like, damn, they're doing it.
Exactly.
We need more taxes from them.
Yep. So what were rich people doing? They were putting millions of dollars into life insurance. And so, and just so you guys know, life insurance is a tier 1 asset. So Bank of America has 19 billion with B in life insurance, right? So the reason why it's like, it's not propagated, on the news. It's not, just shoved down everybody's throat about this and that. It's all we hear about this is the stock market. All we hear about is 401ks. All we hear about is IRAs and yada yada yada, which they all have their value in certain respects. But we're talking about the oldest financial tool, one of the oldest financial tools out there.
Right.
And so, lost my train of thought. What was it?
Well, so I had a point there, and 401ks aren't the best investment vehicle necessarily, and they're still a damn good investment vehicle.
Well, you
right?
haven't
It's
heard
better
me.
than-
You haven't heard me use that term with life insurance. I haven't called life insurance an investment vehicle. It is a savings vehicle.
Okay.
Big difference.
Okay.
Huge difference, right? So that's what I want people to understand is that it's a savings vehicle.
Okay.
All the money that you don't need to operate your life on a daily basis or 3 months or whatever, keep that in the bank. Like you keep your $7,000 to $10,000 in the bank.
Right.
Put everything else into this. Let's call it the emergency opportunity fund.
Okay.
Right? Let's call it the opportunity fund. Because I think some people miss they think they need to save because that's what everything tells them. The internet, their advisor, their mom, their dad,
The TV,
the
Facebooks.
Yeah, right. They're so they tell them to save because that's what you're supposed to do. Well, let's put a reason and a rhyme behind it. Let's save as an opportunity. What if an opportunity comes and you need $1,000 today and you don't have it? Right?
Well, you do if you have a whole life policy, because then you can borrow right against it.
Right, and so exactly. And how long does it take to get money? I can write a check today out of my office.
So-
up to $10,000.
We're on the Real Estate Dude podcast. That's why I said real estate, but really it's a lot bigger than real estate. Where kids' college fund.
That'd be my go-to choice. It wouldn't be a 529 plan.
What about if I get in a car accident today, and all of a sudden I have $50,000 in medical bills?
Yes, you could use your life insurance, cash-free life insurance for that. You could use it to bridge the gap between when you do go to work. You use the money to pay your bills if you need to, or if you have the right. I would call it. We have a lot of life policies have a thing called waiver of disability rider, or something to that effect. Essentially, what it means is if you got hurt and you weren't able to work, you couldn't go back to work. The life insurance company would step in and pay your policy for you.
Okay.
So we believe, when it comes to life insurance, they're self-completing plans, first of all. So that's a big important thing and the reason why it's such a good, fabulous tool to me is it's completely self-completing.
Okay.
So if you die and you have a 401k, what does your family get?
The
value
proceeds out
they
of
get
the 401k.
Yeah, they get the value of the
taxes?
account. Yeah, exactly. They inherit a 401k. There may or may not be some taxes, but that's what they get, right?
Okay.
It's not they get the 25,000 or the 75,000 bucks you have saved, and it could be taxable, or if it's retirement money, it might have to stay in that account, right? And so where life insurance comes into play. Is that if something happens to you, your family gets this tax-free influx of money. That comes. And so not only is you get to a spot where you can save your money, you get almost a guaranteed 4% return on your money. And oh, by the way, that covers inflation and then some. If you die, if you pass away, your family gets this tax-free payout. So it self-completes, right?
Yeah.
Right.
Absolutely.
So where a 401k, it's like they can't retire off of 75 grand, but they can retire off of $1 million, right? So big difference,
right?
Huge difference, and that's.
So my other question is, I have a baby on the way. I want to save for them. One of the most important things that me and my girlfriend have talked about is the value of education, and education costs money right now. Things may change by the time my baby's old enough to go to college, or not go to college. The important thing is we want to provide our baby with the opportunity to find that education.
Okay.
If it's college, it's going to cost money. If baby wants to go to some kind of trade school, be a pilot, it's going to cost money.
Yep.
Really, that step after high school costs money, and we want to provide that for our child because it's the most important thing for us.
It's perfect.
That's where the opportunity is. Baby's born January 5th. I want to start saving January 6th. So I start a whole life insurance policy.
That's what I would start.
Is that transfer? If I start it in my name, can I transfer it to baby's name because he's
So
baby?
how that works is you would be the owner.
Okay.
Baby would be insured.
Okay.
And then you and mom would be beneficiary.
Okay.
Right. And so maybe some people don't like the idea of having life insurance on their kids, but I think there's a lot of value.
That's a whole other conversation.
That's a whole other conversation, right?
Yeah.
But you would be the owner. Your kid would be the insured, and then you and your wife would be the beneficiaries. And so I particularly prefer and recommend life insurance, whole life policies as college savings vehicles versus 529 plans.
Got it.
The reason being are a lot of the things that you touched on. So in a 529 plan, that money's where? Stock market.
Okay.
Right. So it's the same place your retirement money is, right?
Okay.
And so it has to deal with the ups and downs of the market.
Okay.
And the problem with school is there's a specific date. Your kid's not born yet, but we know when they're going to college. Set in stone.
Right.
Right. But the market doesn't work like that. And so one of the conversations that I don't want to have with my kids is the market's down and they're getting ready to go to college. I don't want to say, hey, can you take a year off? I don't want to lock in losses. Your $50,000 account, if we sell anything now, will only be worth $35,000 because the market's down this year.
One of the most crazy things I've ever heard about just the stock market in general, so whatever vehicle you use to be inside the stock market, is the same thing. When you're ready to retire and pull that money out, that date is set. But we don't know what that market's going to look like. So you can have $250,000. For example, people that retired in 2008 got absolutely screwed because the market took a huge hit.
They did, yeah.
And so you might have had $250,000 in 2007, and now you have
Yeah.
$50,000 in 2008.
I was working at the railroad at the time, and I knew guys who had $1 million 401ks that dropped to $400,000. And they're on the verge of retiring. I mean, that is
Now you're in a
scary.
position of you work longer or you lock in losses.
Yeah, exactly.
Or you settle. You settle for that $400,000. That might be enough. You just live a certain lifestyle.
Right. And so when it comes to baby and life insurance and planning for college, we don't know what our kid wants to do.
So let me stop there real quick. The whole life insurance policy doesn't have those fluctuations. It only grows in the cash value based on what you input into it.
Yeah, so I guess
Correct?
that's something we probably should have touched on earlier. The cash value growth of whole life policies are not affected, have never been affected, will never be affected any way, shape, or form by the stock market. So when we talk about the market, that's typically
Let's
what
make
people...
it bigger. The economy.
Essentially, yeah. I mean, in a lot of respects, the economy. I mean,
Unless Country Financial fails, my cash policy is...
That's right. And so most of these companies are here for the long haul. They're not here to end tomorrow.
And that's why the value of having an insurance company that's been here for 80, 90, 100, 120, 200 years is. Because your security is Country Financial's been around since 1800s.
Exactly.
Right.
Yeah. And so not Country Financial specifically, but yes.
in
But
general.
exactly. Life insurance companies have been around longer than, how long has Fidelity been around? How long has Vanguard been around?
Yeah.
How long has, you know what I mean? These other companies that are in the market, that's what they do.
So that's your built-in security. You're not risking the stock market, which has great returns sometimes. And it also has a lot of volatility.
Yeah, and I'm not,
too.
and I'm not saying don't invest in the market. Because you got 99% of our retirement plans in this day and age comes from the workplace, which is a 401k and IRA,
Right.
and therefore that's in the market.
Right.
So perfect. Put money into the match. If there's a match, get it. Absolutely.
Free money. Yeah,
Right.
take
And
it.
let's make sure your money's in the right thing in the 401k. That's where my concern is.
A whole different. That's a
whole
conversation.
Yeah.
Because we can go on and on about that one.
Right. So then, and I'm telling you exactly what I tell customers. Like, this is not. This is exactly what I tell customers. This is why you should do this. This is why I think you should. And these are the reasons why. Not that I'm some, savant and I just listen to people way smarter than me and what's going on.
Right.
And so I know that this country is in massive debt, as everybody does know that. How are they going to pay for debt? How do you pay for debt? Well, either you stop eating out and take that extra money and put it towards your debt, or you try to make more money. Right. Well, in this country, we can make more money, and the government does it by doing what? How does the government make more money?
They make more money.
They raise taxes.
Oh, I thought you just meant like they print more money.
No. I mean,
because they do that.
Yes,
too.
they do that too. Actually, I think they stopped printing money. I think they just like, there was something I heard they stopped printing money. They just, I don't know.
Okay, I know for a while though they were
Probably
like,
just punch numbers into a computer.
we don't need gold standard anymore. We just print a whole bunch of it.
Dude,
we need more. Just print some more.
It's such a joke.
How fast you make them printers work? Print some more money so we can buy a new printer.
So they're going to have to pay for debt. It's going to come up. And what that's going to happen is that's going to increase taxes. And so what that means is every place that's in a qualified account, everything that's in through your workplace, everything that's pre-tax, everything that has taxable growth, you don't know what those taxes are going down the road.
Right.
So what I advise clients to do is try to work to not be beholden by the tax bracket as best as possible. So when it comes to 529 plans, the growth is subject to taxes unless your kid goes to a qualified, you use that money for qualified tuition expenses.
Okay.
Right? And so what does that mean? I don't have the specific definition of what all that covers, but I know it's a tax term, and I know that means the government's telling you what to do with your money.
So would it be something like if I have a 529, which we haven't specified yet, but that's the college savings plan through the market?
Yeah,
right?
that's the most common way that people save money for college.
With the specified tuition plan or whatever, you'd be able to pay for college and books, but not room and board. The room and board proceeds would be taxed. The college tuition would not be. Something similar to that.
Yeah.
That might not be right based on the rules, but
some things are going to be covered and some are not.
Got it.
Right, and here's the other thing with 529 plans. They hurt you when it comes to trying to get free money. So if your family doesn't make enough money, or you're trying to get grants or scholarships and blah yada yada yada, well, if you have $50,000 sitting in a 529 plan because your parents saved all your dividends,
Yep.
like you're missing, you don't get that free money.
Yeah.
But we take that same $50,000 and we plop it into a life insurance policy, right? We have way more flexibility.
Right.
And so what does that mean? Well, what if your kid gets scholarships? Fantastic. School's paid for. Great.
Now we can buy real estate with it and invest and start generational wealth. I'm so obsessed with it.
You could do
generational wealth.
You could buy a fourplex, or a condo where this kid is going to school at,
The
and
real
rent
estate
out to
market
the
is
people.
always going to change
right?
with what's the most valuable
Yeah.
investment, but you give them the opportunity to say, great, you did a good job and you
Right.
studied and got a scholarship, or you're real good at football.
Or they go to a trade school, right? 529 plans don't pay for trade schools. So now, where's your 50 grand? Great, I'll just put on my life insurance policy. What if they decide they want to go take culinary art classes in France and learn that? Well, I don't think 529 plans pay for that stuff, right?
But a whole life insurance policy.
Right, so that's what I'm talking about flexibility, is you have, let's say your kid, I don't know, I have 3 girls. So what if one of my kids decides to run off with some dude on the back of a motorcycle when they're 18? Well, I'm not going to go over anybody. Matter of fact, right?
Yeah.
But what if your kid? I remember when I was 18, I was the mook, right? So if your kid then is going off the deep end, you let them come back to their senses. You own that policy.
So here's my question: you've paid into this policy for 18 to 20 years, right? I start the policy in January 6th, the day after my baby's due. 20 years later, here you go, baby. Baby doesn't even have a name yet.
You're right.
But I'm already paying
Here you go, baby
$100,000
Smades.
for you.
Here you go, baby Smades.
So they start to pull out of the life insurance policy, whether that's pay for school or culinary.
Okay, so yes and no. No, we don't just hand over cash to 18-year-olds, right? So you are the owner of the policy and will be the owner of the policy indefinitely until you choose to hand the policy over.
Or die.
Or die.
Okay.
Right. So Typically, that does happen at 25, but you can sign a piece of paper and say, I don't ever want to relinquish control.
So my question is, I authorize them to start taking money out to go to France and learn how to cook escargot.
Yeah.
Right? They take $20,000 out to do that. How does the payment go back into it? Because that's a $20,000 loan against life insurance.
Yeah, so a couple of things. One, you could choose not to pay back the loan. So it's always an option in a life insurance policy. And what happens...
At what... Okay, keep going, because I think you're going to answer my question.
Yeah, so there's no creditor to come after you. So what happens, right? You take out 20 grand and you don't pay the loan back, then what happens? Well, the VIG keeps going, right? But what happens is they just take the money that you owe off the the death benefit.
Okay.
So you owe 20 grand and now 10 years later you kick the bucket and you actually owe 30 because of the interest. They just take that off. You're supposed to get $100,000. They only hand out 70.
Okay.
Right?
Fair. Because that's my question is, you get a lot of these student loans and 26-year-olds maybe goes to college, racks up $100,000 worth of student loan debt. I can defer the loans for 5 years because I'm not making any money because I'm in college, right? In life insurance, you kind of can defer the loan too just by not paying the loan back until you have the money to pay it back.
Yeah, or you can use your dividend to pay back the interest. You could, it's minimum payments too. It's like $25.
Okay.
Interest payments.
Right.
So you're paying 100. We'll just agree to do $25 until you. Right.
Got it.
So that world is so flexible. It is so normal. Right. There's not stacks of paperwork to fill out for a loan. There's not this credit check. There's not.
At the end of the day, you've earned this.
Cavity search, and
right?
they don't even blood your firstborn, right?
A cavity search.
I must have went to the wrong place. I don't know.
Let me see what you've been eating. Once again, that damn camera. We got the GoPro. Okay, so really my question today, and I think we've answered it so far, is how to use a whole life insurance policy to buy real estate, really to use it as a savings tool.
Yeah.
Right? I think I'm in real estate, so I see the value of it, real estate investment, but really the key is stacking, right? Starting this investment young, so that way at 30, you have this investment that's going to pay for this investment, that's going to pay for this investment, and now you have 3 different streams of income off of one good decision that you made at 20 years old.
Yes. Yeah, there's so many positive aspects to a whole life policy. And what it is just forming a habit. I think it's just saving your money, just putting a little bit away every month creates that habit. And then you're 25 and maybe you can only save $25. But now you're 30 and you're the general manager, and now you're making $120 a year because you were making $12 an hour.
Yeah.
Now you moved up, and now you know what I mean. You move up in your job, and you keep 20% is 20%.
Right.
20% of 1,000 is 200.
Right.
20% of 10,000 is 2,000. Right. So you can see how you just go off those percentages.
Build.
Yeah. And for a young person, the best place, I mean, to start to put $20 away into a little whole life policy is Mint. I mean, how it gets the growth. It's not, it starts that habit early. For a young person. They're super healthy typically, so that's not going to cost. The cost of insurance is going to be super low.
So I got one last question for you. I started 20 years old. Life happens, right? Whatever my decisions happen, I have to file bankruptcy. What happens to life insurance policy? Do I lose it in the bankruptcy?
Never.
Okay.
Never. Not there. This state is protected. I think up to $500,000 of cash value is protected. That can't be touched by anybody.
Okay. So it's really a safe vehicle that allows you flexibility over time. But the way to get into it, the one thing we haven't touched on it, we have actually, but we haven't really said it straight out, is it takes the discipline to pay into the policy every month in order to build cash value to use it as an asset later on in life.
Yeah.
That's the important thing.
It takes the education.
Instantaneous.
That's the problem, right? That's we're into instant gratification. I can look online right now and I can do a million things right now. Right? I can buy whatever I want right now. I can
get a $100,000 loan today.
Exactly.
With 25% interest.
Right.
Right? But I can get that $100,000.
Exactly. The problem is that we aren't emphasizing the importance of a consistent habit. Small, incremental, every month, 20%. If you can't do 20%, do 5%.
Right.
Do like $10 a month, right?
So how flexible can you be with that monthly payment? As far as I'm 26 years old, can I have a $50 whole life insurance policy
Sure.
compared to a $500 whole life insurance policy.
Yeah, so we can do it. We can cut that a bunch of different ways.
So if I'm comfortable with $50, not even 10%, $50 a month, I can still make this work.
And that's what's best about the young kids is let's just do an easy dollar amount. What is comfortable in your world?
Right.
I don't want you to have to choose between life insurance and gas.
Right.
Food and life insurance. No, I don't want those choices.
I do want you to choose between life insurance and that fucking Starbucks stuff.
Thank you.
Let me hide my Starbucks cup real quick.
Do you need that 12-pack? Because we can use the light. Like you could save the money, right?
Right.
So
Right.
it's about being smart with your money.
Right.
And because here's the thing: if you mess up and you make a mistake, and now you do owe money, guess what they can come do if you have your money in a bank account? Sweep your accounts.
Mines.
Yes. Minesweeper. Right? Done.
Yeah.
Just cleaned out. And
So the whole life insurance policy, though, is protected against that.
100% protect. It's you were in relationship with the life insurance company, not with a bank
Right.
who wants you to put your money in there so they can use it to loan to other people.
Right.
The life insurance company wants to be in business with you.
Right.
Simply. And
It makes sense then when you put it that way, because with a 401k plan, at the end of the day, your money is being used to buy these stocks. That's why a 401k plan can be taken away during bankruptcy, can it?
yeah, that's why it's affected in divorces. And I mean, it's part of it.
The whole life insurance policy is my money, and it's also not my money because it's not being used to buy. If I'm in the 401k plan and I put $100 in it and I buy one Costco stock, I own that one Costco stock.
Right.
Here, I don't own one Costco stock.
Well,
we're in a management relationship where you're managing my money to grow it, and we have a contract to pay it out.
Right.
and
You own a
loan
life
against
insurance policy. That's your share. That's how you own a piece of the company.
Got it.
Everybody who has a whole life policy owns a piece of Country Financial, owns a piece of
Got
State
it.
Farm, owns a piece of New York Life. You own a piece of that company when you have that piece of paper, when you have a life insurance policy,
Got it.
when you have a whole life policy. And so what that means is if it's a policy that gets dividends, you get those dividends based on however much, and how
Right.
dividends are calculated for life insurance companies is a dollar amount. So State Farm, because that's who I last worked for, they, let's say $670 million in dividends. Now, how those get distributed is, I have no idea. It's some fancy algorithm that
Okay.
some smart dude knows,
Yeah,
right? So
yeah.
how the money is figured out, I don't know and I don't care. Just the fact that there's a company that pays out free, that gives you free money by having this policy.
Right.
And
Once again, a whole nother conversation. If
Right.
we could talk about dividends all day and what companies do and don't.
Well,
know
yeah,
the value of them. And
people are like, well, I'm not healthy, I got this issue. Well, a lot of times it doesn't take a lot to start the policy. And we don't have to do a lot of companies don't have to do a whole in-depth medical workup on you to start a $20, $50 a month whole life policy. Because the face amount is so small.
Right.
When it comes to life insurance, one of the ways you're rated is based on age and face amount.
Got
So
it.
the higher the face amount, the older you get,
Right.
the more requirements are going to be.
Makes sense.
Right.
So let's clean this up here. What if Joe Schmo, John Schmidt, anybody that watches wants to know more?
Man, reach out. Give me a call. I don't have all my... October 1st is when I officially become a Country Financial agent.
Okay.
Before then, I don't have my Facebook page up. I don't
Right.
have all my marketing stuff available. I don't have any of my branding stuff
Okay.
yet. So all that'll happen next month. And so I guess for now, guys, if you have questions or if you want to know anything, you can email me, mrwitwer@gmail.com.
If you will put that in the comments of the video
Yeah.
and anything we post.
Well, and then anything they reach out to you, you can send Alex any questions too. So
yeah, absolutely. And if I don't know the answer, I'm not going to fake like I know the answer. I'm sending
Right.
it your way.
right.
I'm be like, I don't know. Here.
So I want to clear this up a little bit so people understand, right?
Okay.
So you have your whole life policy, you've built cash, and now you've bought your house, right?
Yep.
You're 32, you bought your house, and now 7 years later, you built up another cash value. Now you go buy your fourplex, your investment property. Well, we use that money from that property to put the money back in the whole life policy, and then 5 years later, we take now 150 or 200 grand and buy the next piece of property,
Okay.
and then take that money and pay back the policy. So you can see how you can, and I mean, maybe we hit on it, but I just want to hit on it, let people understand
Yep.
of how powerful that is and how you can leapfrog in 15 to 20 years.
You're talking about buying real estate that makes money.
That's what I'm talking about.
So that way, your policy is growing all the time. Even when you take a loan against it, it's still growing, right? And then you have this real estate that's also growing, that's paying it back. So now these are both growing. And then 2 years later, you buy another piece of real estate that keeps growing while this is growing and this is growing.
Right.
And so that's how you stack.
And then before you know it, you're in your 60s or 70s, you got $300,000 of cash value life insurance.
Plus 3, 4, 5, 6, 7, 10 investment properties, depending on how you work it.
Yeah, and maybe you don't want to get that extreme, and you don't want to go that far, but you can, maybe you just get a duplex, right? You got one, you live in one side and you rent out the other, but you've saved up money and you use your whole life policy to do it, and you're paying back at, and oh, by the way, maybe 7 years from now, you want to go on a vacation, or you find another opportunity to put money into. Maybe you're buying a property. I don't want to do anything with it, but you need an extra 30 grand. Great. Right?
Right. It's a tool.
Exactly.
It's a tool. We can get into owner finance too because, whoo, man.
Exactly.
I love it.
So, and a lot of these subjects and topics are probably maybe some people aren't comfortable with, they're not sure about, I can't do this and I can't do that. It's really just talking about it and putting a plan in place, I think, for a lot of these people.
I talk all the time about most people. If you're renting, you could probably buy. There's programs out there that'll help you with the down assistance.
Yeah.
And at the end of the day, owning, you're creating a nest egg, right? Rather than renting, you're creating a nest egg for someone else.
Yeah.
So it is very possible for 99% of people to buy.
Where my emphasis is on the home buying part for people is be smart about it. Because you qualify for a $500,000 house doesn't mean you need to buy a $500,000 house. And I'm telling this to everybody. Stay below your means. Save your money. Just because you make $150,000 a year doesn't mean you need to live at $150,000 a year.
I have a buddy that bought a $60,000 condo in Anchorage with no money down. That's why I say literally everyone can get into a house.
Yeah.
Whether it's a condo or a trailer or anything, you can
they
get
have $60,000 condos in Anchorage, first of all.
Listen, it was a once in a lifetime opportunity with no money down too. I had to tell you the story one time. But anybody can get into a house. You're hitting right on the head, and that's where I come in. Listen, like let's take a look and see what you can afford.
That's why I love the way that you do business as a realtor, as a real estate agent, is because you're about the relationship as well. Is that maybe like these people, you have a couple, they're looking at the $350,000 house, and you kind of really find out that they only really make 60 grand a year. You know that's going to be a tough $1,800 a month mortgage payment.
Oh, man,
right?
Yeah.
See, I don't even like it, right? So you can have that conversation with them, and then they've also had the conversation from me, hopefully, and that's where I'd come from as well, is do you need a $350,000 house, or do we do a $250,000 house?
Right.
Or maybe even rent a little bit longer to save some more money so that you're now not at zero with a mortgage.
Right.
And now the roof needs to be replaced. Or, I don't know, the wife backs into the garage, you're going to replace the garage, there's $1,500, right?
And at the end of the day, though, we're going to bring this full circle. Happiness is the most important thing. So if you want that house, but you're willing to sacrifice on all other expenses, let's get you that house.
Yes.
Right? It's all a conversation of where is your value.
Yes, and I've changed a lot of my I guess budgeting ideas and what I think about that to save 20%, spend the rest. Right? It's a very easy to do, very easy, I guess, plan to follow, right? Because it's an age old. It's thousands of years old. You know, go back to the richest man in Babylon. What is their thing? Well, break your money up into tenths is what they say. Okay. So the first 2 tenths you save. The third tenth you use to pay debt. The next 7 tenths you live off of.
Spend it,
right? If you're saving 20% of your money, and that's going to the bank, spend the rest.
Yeah.
Rent,
enjoy
car,
it. You're working for it.
Eating out.
Yeah,
because you've done everything. You don't need to worry about I gotta pay this or pay that.
The most important thing you said is if you break it up in tenths, who's the first person you pay?
Yourself.
That 2 tenths. So shit starts to happen on the back end. This 2 tenths never goes away.
Yeah, it's really
always first.
It's absolutely trying to change that. Well, I got rent to pay. I got to pay gas. You are more important, and that's tough for people. They need all, $1,700 a month that they
because I'm important, but I also got to have a roof over my head.
Right. So there's, and in those respects, what do you need to do? You got to make more money. you needed to make some changes. You
Make
needed-
more money or rent out that room in your apartment.
Right. Go get some roommates. So cut your living expenses in
Right.
half. Move closer to work. Ride your bike. Don't have a car. Right. That's what I did all summer.
Yeah.
Rode my bike to work.
Till it got stolen. All right, we can't solve the world in this one podcast.
I guess not.
Let's
right?
call it. Matt Witwer, Country Financial. He gave you your email. He'll put it in the comments. Starting October 1st, we'll see him in the Wasilla office across from
The fire department in Wasilla.
right downtown Wasilla.
I'm happy. I'm excited. I'm stoked.
He does all of it, right?
I do it all.
Life insurance,
life insurance,
auto.
car insurance, home insurance, business insurance. We talk about retirement, IRAs, all that stuff. Roth IRAs. IRAs. So taxes.
Don't get him started about IRAs again. He'll never stop.
Hey guys, thank you. I appreciate this opportunity, and thank you for listening. For those that have listened and are listening or will listen, so appreciate your time, man.
Let's go eat lunch.
Let's do it, brother.
What is this? It was